On March 10, 2023, Silicon Valley Bank, SVB, collapsed, creating the largest bank failure in the United States since the Great Recession. Just days before its collapse, SVB announced that it had sold $21 billion in securities at a loss of $1.8 billion and would seek to raise $2.25 billion in capital. The bank was closed on Friday morning by the state's financial regulator, and the Federal Deposit Insurance Corporation, FDIC, announced that it had created the National Bank of Santa Clara to protect insured depositors, who would have access to their insured deposits no later than Monday, March 13. The collapse of SVB was the result of a series of tumultuous events that occurred over the past few days. Amid concerns about the bank's stability, some venture capital funds, including Peter Thiel's Founders Fund, advised portfolio companies to pull money out of SVB. CEO Greg Becker told the bank's clients to stay calm, and that the bank had ample liquidity, during a conference call on Thursday. SVB Financial was in talks to sell itself after attempts to raise capital failed, CNBC reported, though plans to find a buyer were abandoned. Shares of parent company SVB Financial were halted on Friday morning after falling 64% in pre-market trading, following a 60% dive on Thursday as investors quickly sold shares. The collapse of SVB had a ripple effect on other banks, as investors and analysts scoped out other problems similar to those SVB faced. First Republic Bank, whose shares fell as much as 52% during early trading, was among the banks that were hit hard by SVB's failure. Just 2 days after SVB failed, New York-based Signature Bank was shut down by regulators, becoming the third largest bank failure in U.S. history, right behind SVB. Like SVB, Signature Bank tried to find a buyer or raise funds but was unsuccessful. Signature had previously suffered because of a bet on crypto, but board member and former Congressman Barney Frank said the final blow to the bank was an SVB-generated panic. On Sunday, the Treasury Department announced protections for depositors at SVB and Signature Bank, assuring depositors they'll have access to their funds on Monday. However, shareholders and unsecured debt holders are not covered by the plan. In a Monday speech, President Joe Biden insisted that the government was not pursuing a taxpayer-funded bailout, stating that no losses will be borne by the taxpayers, and distinguishing his administration's actions from the 2008 financial crisis bailout. The collapse of SVB was surprising, given that the bank reported $212 billion in assets for the fourth quarter of 2022, making it the second largest bank failure in U.S. history, second only to Washington Mutual, whose 2008 failure came as the bank had roughly $300 billion in assets. Prior to its collapse, Silicon Valley Bank ranked as the 16th largest bank in the United States based on assets. The collapse of SVB was the result of a combination of factors. After the tech industry grew during the pandemic, SVB's clients deposited billions, bringing the bank from $60 billion in total deposits at the end of the first quarter of 2020 to nearly $200 billion 2 years later. While deposits came in, SVB invested in debt like U.S. Treasuries and mortgage-backed securities, but as the Federal Reserve began to increase interest rates to combat inflation, the value of SVB's investments fell. Higher interest rates also took a toll on SVB's clients. Startup funding began to dry up as private fundraising became more costly, causing its clients to withdraw funds. Amid the surge in withdrawals, SVB sold assets, including bonds that had lost value due to interest